Here we go. Yeah. Wow. Man, oh man, it feels good to be back.
Dude, a month? Is that what it was?
I think it might have been longer than that.
It is good to be back, man. How you been?
Been great, man. Good holiday season. Good new year. We brought our welcomed our new baby boy into the world on December 16th. So a lot of really good things here, man. What about yourself?
A month? Yeah. Well, a month since the baby. Yeah. Congrats, man.
Yeah, he's a month old today.
Yeah. Holidays, family time. I got a chance to get out of Florida for the holidays. Went up, saw some snow. So Levi, our 4-year-old, saw snow for the first time and just lost his mind. And we went sledding. So it was just a ton of fun, man. Awesome to see how bright they get when they see something for the first time like that. But
that's cool, man. I've never done that myself. And it's skiing and stuff.
Well, it's really cheap and affordable. Just kidding.
I've heard, man. I've heard. For the very low price of 10 grand, you can go out there and ski.
It's hard to live in a place like Florida, and when you start seeing those prices of those ski towns, spend that money up there, you're like, now I'm just paying to suffer in cold weather. But no, we had an awesome time. But I think the last time we've even gone anywhere to see snow is 15 years ago. So
yeah, I've only seen snow like one time my whole life.
Really?
And that actually just happened last year.
Was that when it snowed in Florida?
Weird when I say that. That was so we had a conference in Kansas City last January.
Yeah.
And and it wasn't snow wasn't falling, it was just on the ground already. And it was a good amount. I mean, there was like mounds of it everywhere, but I couldn't imagine living in that crap, man.
No. Dude, I was scared out of my mind to get a rental car. I'm like, how the heck am I going to drive in snow? I don't know what to do.
You were like, where are the chains on the tires?
Yeah, exactly. They're actually in the car. Yeah.
That's nuts, man. Well, that's cool. I'm really stoked to be back. It's a new year. It's 2026. A lot of good things for the industry happening in 2026.
Yeah.
We're very fortunate and blessed as a company to have had a successful 2025. Very humbled and honored to be navigating this company from the cockpit, if you will, because we're blessed, man. I mean, look what we get to do every day is help people make more informed and educated decisions, and ultimately empower them to put the right annuity plans in place for their retirement, and the relationships that we're able to build with these people and along that path of helping them is just, it's incredible, right? Like it's something that I never fathomed would feel this way in terms of how rewarding it is, but we're all truly blessed. And I just want to shout out to any of our clients that are listening, anybody that's given us a shot, whether you did business or not. Thank you, because we're on a mission to make this industry better. We're on a mission to help people make more informed and empowered decisions around annuities and retirement. And without those opportunities, we wouldn't be able to really deliver on that mission. So thank you from the bottom of our hearts.
Absolutely.
Yeah. With that being said, we are going to be talking about the 2026 annuity market, what's on the horizon for the annuity industry this year. And we're going to be really focusing on rates and pricing, innovation with new products or enhancements to existing products, and why timing matters in putting these annuity plans in place. So welcome back, everybody, to the I Love Annuities podcast. I'm Jeremiah Conger.
And I'm Zach Van Ness. Oh, we haven't done this in a while. We are the Annuity Dude.
And today's episode, we got that, man. That's ingrained in us. But we're talking about, like I said, what's on the horizon for annuities in 2026, what's changing, what's improving, and why this current window of time may matter more than people realize.
That's right. So whether you're already retired or planning to retire in the next 5 to 10 years, annuities don't exist in a vacuum, right? So there are direct impacts by things like interest rates, treasury yields, carrier behavior, and innovation that's happening behind the scenes.
And here's the key question that we want our listeners thinking about today is, are annuity rates likely to be better a year from now, or could they be worse?
Yeah, and that's a great point, because if they are worse, does that actually mean for people who waited that they're going to be in a worse spot or a better spot than what they were before?
Yeah, I'll tell you this. One thing that I'm looking at is, I try to stay abreast of the interest rate market because it does directly correlate to annuity pricing. And if you're looking to buy an annuity, especially around guaranteed income, we'll talk about it here later in the episode, but those pricing on income, or those payout rates, are determined by the interest rate environment at the present time of purchase. So my mom is, she just turned 60 last year, or last October. She's hoping to retire within the next 5 years. She's a nurse in the Tampa area. And, we're looking at an annuity for her. And, I told my mom, I was like, look, we got to get this done, because pricing could change on these products, and not change in a good way. It could change potentially for the worse. And I'm not trying to like create this sense of urgency for her by any means, because she trusts me, right? But it's like, hey, we just need to get it done because we don't know what might happen in the next 12 months or so.
Right.
And what I do believe, if I was a betting man, is like, hey, this is probably the best pricing we're going to see for a little while. So let's go ahead and lock it in.
Yep.
So with that being said, let's look at the big picture here and what 2026 is shaping up to look like. If you zoom out for a second, over the last few years, we've seen record-breaking annuity sales, and that's not by accident.
Yeah, and looking at that, it's largely demographics, right? So we look at the peak 65 retirees, which we've spoken about before. You got volatility in traditional markets, people are concerned about, and you've got something we haven't seen in a long time, which is a high interest rate environment.
And that combination creates one of the most competitive annuity environments we've ever seen. Higher caps on growth-oriented indexed annuities, higher guaranteed income from SPIAs and deferred income annuities, as well as indexed annuities with guaranteed income riders, stronger roll-up rates in those deferred income annuities with those riders, and then better payout factors, lifetime payout rates.
Yeah, and as you mentioned, so history does tell us that this may not last forever. I mean, a quick correlation, I think, just from recency, an easy observation would be the mortgage rate environment. Look at what happened during COVID. I mean, rates absolutely plummet to 2 and 3%. And then only a few years after, you're back up 7, 8, 9%. So it won't last forever. And I'm not saying strike right now, but now's a very good time.
Yeah. And so when you look at how annuities are priced, and we'll look at the comparison of income annuities versus growth focused annuities, this is where a lot of confusion comes in. Annuities are priced very differently depending on whether the goal is income or growth. So if we look at income annuities, lifetime income is priced off of interest rates and longevity assumptions. So there's actuarial science and tables that are being used to determine the risk to the carrier based on that person's lifespan. And so that directly prices, or impacts the pricing rather, of those income annuities. So when you have higher interest rates, it equals higher payout factors on those income products. So locking in those income products today locks in those current rate environment assumptions.
Yeah, exactly. And then once that income is turned on, that payout is contractually guaranteed. So if rates happen to change down the road, the income amount you receive does not change at all. And in looking at this, we also consider annuities that are intended for growth or accumulation, right? So we'll look at things like fixed annuities and fixed index annuities, and how that's affected from the carrier portfolios. And oftentimes the rates are affected there. So that may be a higher or lower rate in terms of the cap, maybe a higher or lower participation rate. And going back a little bit to the income component, that income rider, the roll-up rate may also adjust there. So lower rates usually means a less generous term in that annuity.
Yeah, and this is why timing matters, not for market guessing, but for contract mechanics. Really, how are these products benefiting you and helping you achieve your goal? Well, if it's growth focused, we know those caps and participations or fixed rates impact your goal of safe accumulation. So the lower those rates are, the lower your goal will be achieved, or less likely, or lower on a lower level will it be achieved. Same thing with income. Income is your goal. You can get more income in a higher interest rate environment for less premium investment. So it makes sense to understand that. And that's why timing matters, and the pricing of these products matter as well. Actually, we just seen last year, not to cut you off there, but last year and even the year before in 24, we saw a bunch of our existing clients that had purchased income or growth oriented accumulation focused annuities in years past, 2020 or 2019 or even 2021.
Mm-hmm.
And we saw that when those products and those contracts were issued in those, those years where we were in a lower interest rate environment, they were priced as such. Those products were priced as such. And so what we do with our clients, when you become a client of Annuity Association, we meet with you every year and we help you understand the performance of your product. We help you maintain it. If there's index reallocation opportunities, we help you analyze what's available in those and what those opportunities are, and should we reallocate towards other strategies or keep it in the same one. But also what we do is an audit on income annuities, where we'll say, hey, well, we know that you purchased this annuity for income in 5 years. And we know based on the illustration when at the time of purchase that the guaranteed income was X. Well, when we do that income audit, we look at the current marketplace to determine, hey, does this person benefit from swapping out this annuity or exchanging, which is the technical term, this older annuity for a new one? And we saw a significant opportunity in people that purchased annuities just 3 or 4 years ago, where if they exchanged that old annuity for a new one, their guaranteed income payouts like dramatically increased. Like it was a significant difference. And it made sense for most people in that scenario. So we did a lot of exchanges, which is interesting, but further alludes to of what we're talking about, to the facts of what we're talking about. And that is pricing matters and interest rates matter. And when you have these products that are correlated to interest rates, you have to play the game, right? So like knowing that we're on a downward trend, possibly with these interest rates, annuity pricing is probably at its peak right now.
Yeah. And it is interesting. I don't remember if you recall when we spoke with one of the IMOs, they had put out some number. I don't remember, some ghastly number of how many annuities were exchanged in the most recent year from those at which just at the time they purchased, they just weren't competitive just due to the interest rate environment. And that speaks directly to the 10-year treasury and how that has an impact on annuities today. So talking about the 10-year treasury, because it is the backbone really of annuity pricing.
Yeah, so insurance companies don't speculate. They buy long duration, high quality bonds, many of which are tied to treasury yields.
That's right. So when the 10-year is higher, carriers earn more on their reserves, which means they can afford better guarantees for the consumers. In addition to that, consumers can see better income and growth potential from their annuities that they own.
So let's talk about what happens when that 10-year treasury falls. Well, that means the cap rates are going to compress. Participation rates are going to be reduced. bonuses, if there's bonuses involved, which, you all know by now, we're not real big on bonuses unless it, a rare instance where it makes sense. But bonuses will diminish or lessen, and income payout rates will soften.
That's right. So when we look at this, as we mentioned at the beginning, we're really trying to evaluate what may happen in 2026. And one thing I can tell you is my crystal ball has not been working for the entirety of this NFL season. I've only lost money on the bets I've made. So I don't know about yours, Jeremiah, but it's not working. So we really can't look at that crystal ball right now to hedge our bets, but we can look at some of the incentives that are being offered from these carriers for annuities.
Yeah, that's true, man. Yeah, my crystal ball didn't work really well this year either, so I'm in the same boat as you, man. So central banks eventually move toward easing when inflation cools and economic pressure builds.
That's right. So what this is going to mean is that the risk is asymmetrical. So if rates are higher, you can expect a modest upside. If rates go down, if they're lower, you can expect permanent loss of opportunity for those who waited.
Yep. So it's that word that we always hear, right, in finance is the opportunity cost, right? So
That's
there
right.
is opportunity cost or loss of opportunity in making bad timing decisions on the low end of that interest rate environment. So this isn't about fear. Absolutely not. I believe that everybody should purchase an annuity when they're ready. But if you're getting close to being ready, it really makes sense to try to get in while the iron's hot, right? Strike when the iron's hot. So it isn't about fear. We would never use fear of loss or fear of missing out, right? The FOMO effect on trying to persuade somebody to move forward with signing on the dotted line. That is never our intent. We would never do that. And anybody out there that's really trying to do that, which we know that in our industry, unfortunately, that's a common scare tactic, right? To move people forward is like, oh, these rates are going to change, and oh, this is coming down, and we better sign now, and da 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 da. That's not our philosophy. We've never been that way. If there is a rate change on a product that we're looking at with you, obviously we're going to do our part in educating you about that or informing you about those changes. But honestly, that we would never use that to our advantage to push you across the finish line, because we know that that's not the right thing. And anybody that is doing that to you, gosh, I ask that they stop, or the association's coming for them.
That's it.
So anyway, it's about understanding, your option and value ultimately of making those decisions. So comparing the benefits of now doing it now versus waiting, that should be weighed out with you, and that's something we would do.
Yeah. So 2026 at a glance, we'll evaluate everything as time goes on, meeting with clients and understanding what their needs are, but no direct pressure or anything like that to move forward immediately out of fear, right? And another thing that we're looking at going into the new year is innovation and new products. What I think we've seen in a very short amount of time is the flexibility and the adjustment that these carriers are making to really recognize from a consumer's end what they're asking for. So we're starting to see that they're listening more and taking that feedback and incorporating that. And that's one example, what we call the MYGIA, which is a multi-year guaranteed indexed annuity. It's one of the more exciting innovations that we've seen in the annuity marketplace, and it's just really starting to get legs.
Yeah, I think there's only a handful of these products from different carriers available as of the time of this recording, but it's been one of the more innovative, unique products that I've seen since I've been doing this, and I'm actually really, really excited about what's coming in this space because of this innovation. I think that this is like kind of the biggest area of need in the product lineup, in the annuity type lineup. Was you had these MYGAs, which were like a CD alternative, generally offer higher fixed rates guaranteed for the duration of time, and the only difference really being that they're offered by insurance companies, and then obviously they have a surrender period that's normally associated with an annuity in general. But and then you had from a MYGA, then you had this fixed indexed annuity, which was a guarantee of principal protection, non-guaranteed growth via index crediting strategies, and the option to add guaranteed income riders. You had SPIAs, just an income product, right? Straightforward. And then you had the variable annuity, which, nobody likes those really, at least in our camp. So in regards to where the void was, or the gap between those types of annuities, was, you had people that liked the idea of having a guaranteed fixed rate, but, sometimes people are hesitant to lock in to that MYGA product because, they're anywhere from 3 to 10 years in terms of the commitment. So they're also kind of, I guess, one of the biggest hesitations is like, well, if I pull this money out of the market, I'm going to miss out on any upside of the market, and I'm only getting this fixed rate. Okay, great. Well, that's honest and understandable hesitation of why you feel that way. But then you had the indexed annuity, right? That said, well, hey, we'll give you a guarantee of principal protection. Your money's not exposed to risk, but how it earns interest is from these indexes that are market linked. And then people say, well, I don't want to only be able to earn interest if the markets go up. I have fear that if the markets don't do anything or they're flat, I'm not going to earn anything. So that was an objection. Where the MYGIA really stands and really holds a lot of weight in this discussion or this situation or scenario is that it offers you the benefits of both. It has a strong fixed rate guarantee with upside potential. So you may get a little bit less on that guaranteed fixed rate. So let's say you can get a 4% fixed rate as an example, but you might be able to get even more on top of that 4% floor if the index strategy performs over that contract. So I think that's a very innovative product. It's huge. It addresses a lot of the gaps, but I really, really love the design. And I think that once there's more awareness around this product, I think it's really going to take off. What do you think about it, Zach?
Yeah, I couldn't agree more. I mean, it's actually gotten to the point now where we're seeing presenting it to clients. It not a challenge to present it. It's just first a challenge to make sure we understand annuities at its core. And then presenting this brings a new dynamic to it. I think resonates with a lot of clients. To your point, having some type of guaranteed return, give me something out of this. And if I have potential to perform even better than that, it's tough to argue. And Matt and I are actually, was just on the phone with him before we started recording this. And that's our next recording that we're doing on the Annuity Researchers series. We're going to take a look at MYGIA, and then we can actually show a real life example of it.
Yeah, I actually have one client, existing client that, he's just him and his wife are just a blast to work with. They're super funny. They live out in Kentucky, and they have a farm. They like harvest their strawberries and blueberries and things like for fun. I think they do sell them, but it's just more like, hey, we're retired.
Sure.
We don't really have a ton of shit to do. I don't know why I stuttered at first, but then I thought it was funny, so I did it again. I think it's because I was like in my mind, I'm like, I shouldn't cuss on this show, but then I'm like, well, why not? It's my show. It's our show. But anyways, so he was like, so what else? What else? I got this money. He's got, they got a few bucks, and he's like, I've got a little bit of money that I just want to kind of play around with, but I don't want to take a ton of risk. He already owns an indexed annuity that's doing well for him and his wife. They both have one. And then he had a couple MYGAs. He actually locked in some MYGAs back when they were like above 6%, locked them in for
Nice.
10 years, which was awesome. But he was like, what else is out there? And that was right around when these MYGIAs were coming out. And I educated him about it. He's like, hey, you know what? That sounds pretty cool. Let's give it a shot and see what happens. So he got one that's offered by Revel One. And that product is called the Accelera. What's it called? Hold on, let me pull it up. Accelera Plus, I think is what it's called. Forgive me, there are friends at Revel One. I think it's the Accelera Plus. Yeah, Accelera Plus MYGIA. And anyways, it's got a 4% floor and then it has upside via the S&P 500. Very simple product.
Mm-hmm.
And I think it's cool, man. Like, I'm hoping that over the time frame, it's gonna grow according to the the S&P. But he knows for sure that he's getting a 4% guarantee on his money, and it's a 5-year contract, so it's shorter duration. But he knows he could get anywhere from like 6 or 7, maybe even 8% if the index performs well.
Yeah, so it's
I
the
just think
better of that 4% or however the S&P performs in that window of time, whichever
correct.
performance is better is his net. Yep.
That's right. Yeah, if the S&P outperforms the 4%, he gets the higher of the two.
Yeah, yeah.
Just
And
a cool
I
product, man.
appreciate that they found a way to make it more simplistic. I think the harder equation that we run into quite a bit is, well, which index do I pick?
Yeah.
And there's so many to choose from. Well, there's a simple path to that if we want to try to make it a little bit easier. I love that. Yeah. Yeah. So we'll do annuity researchers on that.
Yeah. So for those that aren't aware, we also have another podcast show. It's actually published or produced on YouTube. It's where Zach Van Ness, one half of the Annuity Dudes, is also partnering up with one of our senior annuity advisors, Matt Sluizer. Great guy, super smart.
Yeah.
But they conduct product reviews, so they delve into the specific features and benefits of the various products on the market to really bring more transparency and education to the nuances of each product, so that you can really understand them. And I'm excited to hear what you guys come up with. Are you guys going to do one product, or are you going to do like a comparison of the multiple MYGIAs?
So the idea is that we do the one product and maybe compare it to a MYGA and a fixed index annuity just to understand the operation of it. I'm sure we'll do more. I mean, as you've seen on those, we've done multiple fixed index annuities. We've done multiple fixed index annuities with the income rider. So continuing on that trend, I'm sure at one point we'll start comparing those though.
That's cool. Yeah. This, what's neat, man, is like this MYGIA was no joke. Like the one that I put in place for my client, 4% guaranteed floor. So that's the minimum it could perform over 5 years. But it has a 60% par on the S&P 500 for that 5-year period.
Right.
Like,
you want to break that down a little bit for the listeners?
Yeah. So again, it's either or. It's the higher of the two options. The minimum that he could earn is 4%. That's guaranteed. So if the index did 0 for all 5 years, my client's getting 4% no matter what. So it's better than a money market. It's better than a bank CD today. And it's pretty good even in the MYGA realm, right? It's fair. So, but if the S&P, and it's the pure S&P 500, if over that 5-year period, the S&P 500's performance after factoring in a 60% participation rate. Let me define what that means again. Whatever the raw performance is of that S&P 500 for those 5 years. So let's say it went up, 50%. So that'd be 10% a year. Just the S&P went up 10% a year, but the raw performance or movement from year 1 to year 5 is 50%. Well, my client would participate in 60% of that 50%. So in other words, he would receive, that would be 30% of performance. So in this product, he gets the higher of the two. So if you take 30 and then divide it by 5, that's 6% annualized return. 6% is higher than 4%. So he would receive 6% in that example. Does that make sense?
Yeah. Yeah. And I mean, if we look at the S&P in the last 3 years, what do we, probably 23, 24%. And then I think 17 this past year.
Oh, yeah. I'll pull it up right now.
Yeah.
Actually, what I'll do is I can run back and do like a last 3 years or last 5 years.
There you go.
Let's do that. So on the S&P, let me share my screen, man.
You want me to just call Matt and add him in? We'll do the researchers right now.
Might as well do it now. Let's see. You gonna download for me? Hold on. There it goes. All right. The last 5 years has been an annual return of 13.01% on the S&P. Let me share my screen.
There we go. Okay.
Just realized I didn't share it.
13.01.
Yeah. So you then multiply that by 5 years.
Yeah.
All right. Can you see it? So this 5-year period, 13.01%.
Yep.
Times 5. That's 65% times 60% participation. That's 39.03 divided by 5. So in that 5-year window that my client bought that annuity, if he owned it in that 5-year span that we're now referencing, he would have earned 7.8% a year with no downside risk. And 7.8 is higher than that 4% floor. So he gets the higher.
I was gonna say, not only is it no downside risk, but a minimum of 4%.
Yeah, it's freaking amazing, man.
Yeah.
So I would love for that to unfold for him and happen. But I just thought, man, that's a cool product. There's a couple others out there, one with Puritan Life. There's another one that American National just came out with called the Rate Certainty Guaranteed Annuity. That one, I believe the minimum contract on it's like 7 years, though. I don't think it's 5.
Yeah, it's a little bit different. Yeah.
And then
kind of stands on its own.
Yeah, and then there's one more, and I can't remember the other player, but the other ones that we looked at, I think American Life is the other one.
American Life, Ibexus has a kind of the MYGA plus, a little bit different.
Yeah, and we tried to do the analysis, not tried. We did do the analysis. I liked the Revel one because it was really simple.
I did too, yeah.
The other ones, you have to like play with the allocation. Like, oh, okay, well, this one has a 5% fixed rate bucket, but you have to allocate a percentage towards it, and you can like customize the floor, if you will. But then you limit what allocation's going towards the upside potential, right? And then the other one with American Life has a bonus that's like, hey, if the S&P is higher than the minimum, then you get this bonus that's applied. It's just a little bit different.
That's why I didn't love comparing it side by side, because they all function a little bit differently from each other.
Yeah.
Yeah.
Yeah. So
more innovation in the annuity world. That's one example of it. And I think another example that we've seen more recently, Ocean View, it comes to mind, in that they've got their new fixed index annuity with that lock, right? I think they call it the cap lock, where it guarantees a rate cap of a certain percentage for the entirety of the annuity term. So we're starting to see that more frequently as well.
Yeah, for sure. So yeah, a lot of cool things happening. Really excited about the MYGIA product and it finding a place in the industry. I think, again, once that awareness is made to the agent and advisors as well as consumers, I think it'll really take off.
That's right.
So with that being said, let's go ahead and wrap this thing up. So let's see, where are we at? Yeah, let's talk about it. So, to be very clear, annuities are not a now or never, equation, right?
That's right. Today's contracts are priced off today's rates.
And then once rates fall, carriers don't retroactively improve old offers.
Yeah. And when we're looking at that, the real risk oftentimes comes in not acting and not making a decision. So sometimes that can be the detriment.
So really what we want you to walk away with here is annuity pricing. It is rate sensitive and income decisions can be permanent at times, especially if you don't have a company that's reviewing your product with you every year and seeing if there's upgrade opportunities like we do. Innovation is also accelerating in our space, and timing matters more for guarantees than just pure performance.
That's right. And the best move is not guessing, it's getting informed, which is exactly what we help out with.
Baby. And if you're listening and thinking I should probably understand how this impacts me, you're right.
That's right. And that's why we build the tools and resources. Oh, do it again.
So to go with that, hitting the bongos there, if you're interested in finding out, hey man, what is the annuity rate environment like right now? If I'm looking for income, what is the best deal I can get? And you're wanting to look at it from a holistic approach, having access to all the carrier products on the independent annuity marketplace, that's where we come in. We welcome you to visit our site, or more importantly, if you're listening to this show and you want to meet with someone like Zach from our team, there's a link in the show notes here that you can schedule a time to meet with one of us and schedule a discovery conversation so that we can understand what's important to you, what matters most, what your goals and objectives are for you and your family near and long term. And then we'll bring that transparency to the table, and we'll show you exactly how to evaluate the marketplace using our unique multi-point annuity inspection framework. And that's something that we would be honored to have the opportunity to do, because why, Zach?
We are the I'm just ready to go.
We are. Because we are the annuity dudes. And ultimately, the goal isn't just to sell you an annuity. It's to empower you to make a better decision around the right annuity, right?
That's right. And keep in mind that when you are meeting with an advisor regarding annuities, anything like this, there should be no fees. There should be no pressure. This is to help you plan better for the future. This is not anything where we're being compensated to assist you down that path. Unless a decision is made, but at this time, you're not compensating us. That's all coming from the carrier. So just know that there's no pressure that comes along with that time commitment that you make to learn about annuities.
This guy was good.
All right. With that being said, this wraps up our first episode of 2026. This is the I Love Annuities podcast. I am Jeremiah Conger.
I'm Zach Van Ness, and we are the
Annuity Dude. Signing off. Yeah.